So, one of the most common questions that I get about retirement planning is whether someone should contribute to a traditional IRA or a Roth IRA. And it's a great question, and it has a lot to do with tax rates, either now or in the future. And let's start with talking about what an IRA is. Congress decided long ago that they wanted the American people to save for retirement, and they wanted to incentivize them to do that. And so IRAs were created to help provide some tax benefits with their saving and investing. In either case, whether it's a traditional IRA or a Roth IRA, any money that's in that account does not get taxed each year as it grows. So if your IRA makes 7%, then it doesn't get taxed in that year like it would if your savings account made 3%. And so that's one of the benefits of an IRA. Now, the traditional IRA versus the Roth IRA depends on when you get another tax break. So on a traditional IRA, you get to deduct the amount of the contribution that you make to the IRA. When you pull the money out after age 59 and a half, that money is then, and all the growth associated with it, is then taxable. So whatever you withdraw after age 59 and a half will be taxed at your tax rate at that time. A Roth IRA is just the opposite. You don't get any sort of tax break by contributing to a Roth IRA in the current year. However, as it grows and when you pull that money out after age 59 and a half, then any money that you withdraw comes out tax-free. So anything you've contributed, all of the growth, comes out tax-free after age 59 and a half. So it really depends on where you expect your tax rate to be now compared to when you retire. And when we talk about tax rate, really we're talking about your marginal income tax rate. So if you expect that your marginal income tax rate is actually going to be higher in retirement than it is now, then a Roth IRA makes a lot of sense because you don't need the tax break as much now as you will later. Conversely, if you expect that your tax rate will be less in retirement, then it may make more sense to take the tax break now and contribute to a traditional IRA and then pay the taxes when you take out your distributions. If we put in the maximum contribution for 2025, which is $7,000, into a traditional IRA, then we will be able to deduct $7,000 from our income this year. The money will grow. And if we assume a 7.2% rate of return, and that doubles, every 10 years. So after 10 years, it would be 14,000. After another 10 years, it would be 28,000. And after another 10 years, we'd be looking at 56,000, again, assuming a 7.2% rate of return. Then out of that traditional IRA, you could withdraw funds from there. And let's say you pulled $20,000 out. Well, that $20,000 is going to be added to your taxable income in the year that you make the withdrawal. Again, because these are IRAs, we want to wait till age 59 and a half so we're not penalized for an early withdrawal. Out of the Roth IRA, if we make a $7,000 contribution this year, we don't get any sort of tax benefit this year. And again, it grows 7.2% over the next 10 years. It's 14,000. 20 years, it's 28,000. 30 years, it's 56,000. And then we go to pull out $20,000 at that time. Well, then it is $20,000 that we get to take out tax-free, which again can be a great benefit. Now, another thing to factor in and consider is between the Roth and traditional IRA, because there are limits, and the limits are the same for each one, if you're looking at actual spending power, and you can contribute $7,000 to each one, and you could pull out, say, $56,000 in 30 years from that initial contribution, well, the Roth IRA actually allows you to save and have more spending power, because if you were to pull that $56,000 out from the traditional IRA, you've got to pay taxes on it. If you're to pull it out of the Roth IRA, you get that full $56,000. So that leans a little bit in favor to the Roth IRA. One other benefit of the Roth over the traditional is you can actually pull out your contributions at any time, even prior to age 59 and a half, without paying any taxes or penalties. If you do touch the growth before age 59 and a half, there is a 10% penalty. And so generally you want to avoid that. But that gives just a basic understanding of Roth versus traditional IRAs. Again, a lot of it comes down to where you expect your tax rates to be. And hopefully, as you go through these decisions and you start aligning what you're trying to accomplish with your values, for a lot of people, the values are being wise stewards and being able to take advantage of the tax benefits that are out there is one way to be a wise steward and align your financial values with your financial decisions. And again, hopefully that leads to happier wealth.